This is Christian Jane Kongsted, and this is my quarterly update for Q3 2024. Today I'm going to speak about my performance on eToro, where I trade and invest under the name of CPH Equities. As many of you know, you can copy my trades, and some of you are copying my trades. And this video also goes on YouTube, where people can follow me too. I'm going to speak about my performance, about the portfolio, how I have diversified the portfolio, and also some things about the current markets. And then I have a few questions from copiers and followers on eToro. First of all, I'm not going to say so much about myself in this video because I made a short video, which is 2 minutes, that you can find by searching for CPH Equities on YouTube. You can find this video to get an impression of who I am and how I invest. And I think that's a good way to get to know me a little bit better. And then in these updates, I'm going to speak a little bit less about myself and more about the stocks and my investments. So go on YouTube and search for CPH Equities. My performance over the last 8 years, where I've been on eToro, has been an annualized return of around 21% on average. This means that there has been much better years than this, and also 1 year that was worse. But 7 out of 8 years, I've been having double-digit returns. And this year, it's always also going pretty well. We have returns of around 20% this year, which is about around my historical average. And I have a long track record of performing and overperforming the market. And as you can see here, the chart here is comparing my returns with my benchmark of S&P 500. And I've been having returns of around 280%, while the S&P in the same period has had 140%. So I've had almost twice as high returns as the S&P 500. My goal with being on eToro is to take my account to $1 million, and I've calculated that this should take me around 14 years from this moment. I'm slightly ahead of my goal. I started 2 years ago, and I'm right now at $123,500, and I'm supposed to be at around $119,000 at this point. So I'm slightly ahead of my target, and if I reach my target in time, then it's going to be at around August 2038. And I invite you to follow me on this journey because I think that's a good goal to have, and it's a goal that makes sure that I stay focused and stay on track on getting the best returns that I think I can give. The portfolio is constitutes of a few different parts. The main part and the core of the portfolio is focused on tech and AI. I have companies like Meta, Nvidia, Microsoft, Amazon, Google, TSMC, Apple as some of the main companies in the core. And I also have a group of semiconductor stocks that adds up to this core of the portfolio. And in total, right now, the core, which is this tech part of the portfolio, it's around 37.7%. Of course, it fluctuates a little bit, but that's the main part of the portfolio. And as you can see from this screen dump, which is taken from a tool called Bullish, you can see that I have a good diversification amongst many sectors of the stock market. So it's not only technology that I'm investing in. I'm trying to keep and invest in good stocks from most of the areas, and also have a bit of crypto, in fact. Very little part. It's like 2% of my portfolio at this point. So the core of the portfolio is focused on AI, tech, cloud computing, cybersecurity. And then I also have 2 other parts of the portfolio, which is a value-oriented part, which invests in some quite different stocks, and a short-term momentum part, which is usually shorter trades that is focused on exploiting the momentum that's a very strong force in the markets, and trying to find some stocks that have a completely different character than the stocks in the two other parts of the portfolio. And by dividing the portfolio into three different parts, I ensure that it's very well diversified. It has very different stocks, and it also means that when the tech part of the portfolio does not perform well, then usually the other parts of the portfolio, at least one of the other parts, does well. And in this sense, that it can mitigate losses in period where tech is underperforming. And then again, when tech overperforms, then sometimes you see one of the other portfolios underperform. And in this sense, it makes up for good diversification. About the current markets, the last month has been pretty positive for most sectors, especially tech has been coming back. Nvidia with strong returns over the last month. We've also seen the banking sector, the finance sector doing well, and a few other sectors doing well. Energy coming back, but sectors like healthcare and consumer defensive doing less well, and also real estate not doing very well. Looking at a 3-month horizon, the picture is more mixed, but obviously it shows that some of the mega cap stocks that we have been investing in has been taking a pause for the last 3 months. Some of them have been doing okay, like Meta. Others like Microsoft, Google have been doing less well. And in general, those stocks did very well for the first half of the year. And if you look at them year to date, they're doing pretty well still. So this is how the market fluctuates all the time, and I think it's something that we should, of course, pay attention to, but also be aware that we cannot like chase the market all the time. The portfolio cannot overperform at all points. We need to keep some stocks that we have high conviction in, and then focus on those, keeping those stocks for a very long time, even if we've been having a period of 3 months where some of those stocks have been underperforming. But looking at this year, last year, the performance of the portfolio is doing very well, and I'm quite happy with how we're doing. We are more than 20% up at this point, and yeah, it's just not much to complain about. Of course, there's been a little bit volatility, but you never have a year with the markets going just straight up all the time. So this is to be expected, even in a good year. And as many of you have seen and have noted, the market has reached all-time highs. And I'm going to get back to what this means, what this usually means, because for some people, it's a scary thought that the markets are at all-time highs. But I've gathered collected some statistics to talk about what usually happens when the markets are at all-time highs. So I'm going to get back to that later in this recording. So US inflation has been coming down slowly, and we reached a level of 2.5% on the core PCE, which is the main measurement that the US central bank uses for measuring inflation. And then it ticked up slightly on the last report here to 2.6. But in general, things are looking pretty good with regards to inflation. And it looks like we are going to get closer to the target of 2%. But of course, there's still a risk that this picture could turn around. So we shouldn't be too sure about inflation going away. I think it's likely that it could come back at some point, and maybe it's going to be sooner than later. So rather than later, so we'll have to keep an eye on that. The bond market is now pricing in 2 more rate cuts as the main scenario for the rest of the year, but also a slight chance that there's only 1 rate cut for the rest of the year. And the reason why I focus on this is that rate cuts is usually a good thing for the stock market if you can avoid a recession. So what we want to see is obviously the Fed continuing to cut rates and doing it in an environment where we avoid a recession. And if that happens, then it could be a quite positive scenario for stocks. But I'm going to get back to the statistics on that later. So in general, the market expects the Fed's fund rates to fall during the last part of this year and also next year, and then bottom out and hit a neutral rate of around slightly below 3% at the end of 2025. And we'll have to see how it plays out, but that's the expectations that we have at this point, and it changes a little bit all the time. But the market expects the rate to come down quite a lot further. And if this happens, it's probably going to be a positive thing for the stock market, especially if we can avoid a recession. So looking at the other part of the equation, which is the risk of recession, Goldman Sachs has just adjusted their recession risk estimate down again to 15% within the next 12 months, which is a normal risk of recession, which means that there is no extra high risk of recession at this point, according to Goldman Sachs. The Bloomberg consensus is slightly higher. It's around 30%. But for the last years, Goldman Sachs has been having the lower estimates for most of the time. And actually, it turned out that they have been right so far. They've been more right than the consensus. So consensus estimates were that we would see a recession. But in fact, we haven't seen that. And now Goldman Sachs is saying that we have a normal risk of recession within the next 12 months, and that's a 15% recession. So the most likely scenario is that we will not see a recession within this period, but of course, there's some risk of recession. So at this point, it actually looks like that we may be on our way to the soft landing that the Fed has been speaking a lot about and commentators have been speaking a lot about. We are on our way to 2% inflation in the US. The economy in the US is resilient, and the market is pricing in those 2 more rate cuts in 2024. And obviously, a lot of things can happen, so it's not like we can be sure of a soft landing, but it's still, at this point, the most likely scenario, it seems. So what will happen for the rest of the year? That's the question that a lot of people probably will ask themselves. And the thing is that we only have like 2.5 months left of this year. So to predict stock markets in the short term is usually quite difficult. But I will tell you what the statistic that I'm looking at, they show me, and then you can make up your own mind based on this. So usually in election years, we see a pattern where after the election is decided, which this year is the 5th of November, we do see, on average, a slightly positive rally from the stock market, which is kind of a relief rally when the election result is finally here. This year has been quite different than many other years. So I think that we had the pullback in July and August, which is the opposite of the what we historically have had. So this correction in the market came earlier this year. And then September, which is usually a bad month, was actually a reasonable month in the stock market, was slightly positive. And now we'll have to see how it plays out. But the usual thing to happen would be a relief rally as soon as the result is known. So that's at least statistically the most probable scenario. But already now we're seeing kind of a positive development here in October, which is a little bit unusual. So we may already be having some of this rally that we would expect to have after the election result. But still, we may see a rally after the election result as well. So that's going to be interesting to follow. And then this show the average monthly returns, and actually the quarter that we have started now, which is Q4, is usually the most positive part of the year for the stock market. Actually, the next 4 months, including January, are usually very positive months for the stock market. So it's certainly a time where you would usually like to be invested. on average, but of course, anything can happen in the stock market. And we had, for instance, in 2018, a huge correction in December 2018. So it's certainly not sure that we will see a relief rally after the election. So we cannot be sure. It's just the most probable scenario at this point. Looking at those historically positive years, which we are having like right now, we see an overview here of 20 very positive years, where the first 9 months of the year were had returns of 17% or more. And what we're seeing in general in those years is that when we look at how it goes to the year end, it's usually positive years and years that keep on staying positive even for the next month as well, with some notable exceptions, of course. So if we look at like 1929, which was obviously the Wall Street crash, that was not a good year. And we also have had other years like the 1987 with Black Monday, and other years which were bad years. But on average, the years that start very positive usually also ends quite positive. So that's when we look at the statistic, that's the way it usually goes. So we have been seeing like 68% positive years in those years that start very well, and 32% negative years. So that's what the historical odds are. And of course, we can never know for sure what's happened, but these are historical figures. Then another point is like, what happens if you buy the stock market at all-time high, which we are at now? And actually, analysis made by UBS shows you that on average, buying at all-time high is actually slightly better than buying at a random point in time, which means that in 32% of cases, you will not see your investment go into the red if you buy at all-time high on average and looking at historical figures. So this number is slightly lower if you buy at a random time, which is 28% of cases. And also, in only 15% of cases, you would see a loss of more than 20% if you buy at all-time high, and this is 19%, which is 4 percentage points higher if you buy at a random point in time. So this means that on average, buying at all-time highs, even though it can seem scary because valuations are usually high at this time, then it's actually on average more safe to buy on all-time high. And the reason for this is that these are usually good times when you have all-time highs. These are usually good times for the stock markets, and all-time highs are usually followed by new all-time highs. So let's take a look at this. For instance, this is the stock market of the 90s, and we had, in fact, 314 all-time highs during the 19s. So we had all-time highs all the time, and at many points you would be probably scared because valuations were very high, and in the end also you had the bubble bursting, but that was only after having 314 all-time highs. And at this point in time, I think we're more likely to be at around, like, for historical comparison, like 96, 97. So in a period where we are building up, but things are still going good, valuations are high, but they can still get higher probably. So I don't see this as a bubble, because compared to the 90s, this rally is led by some of the richest companies in the world, some of the most profitable companies in the world. And it was a quite different situation in the 90s. But of course, we cannot say for sure that it's not going to develop into a bubble. I just think that at this point, it's not a bubble yet. So, and another way to illustrate this is to show historically, like, for instance, looking at the 90s, you had all those all-time highs until we reached 2000. And then the bubble burst and we didn't have any all-time highs for many, many years. But actually investing like early in the 1990s when you still had a lot of all-time highs would have been a very wise and very good decision. So being at an all-time high shouldn't scare you in itself. It's actually on average a quite good time to buy. And I just want to say for sure that this is not investment advice. I'm not advising anyone to buy the market or doing anything specific. These are just my thoughts, and this is historical comparisons, historical odds that I'm speaking about here, and not necessarily about the future. So here's an overview of what is expected to happen, and we expect that the Fed's funds rate will go quite quickly. The market is expecting that it will go quite quickly down to a neutral rate of about 3%. And since 1980, 5 of the 10 best years have actually been when the S&P have cut the Fed has cut rates without a recession. So these are the years that I mentioned here. If we can have a rate cutting cycle without a recession, it's a very positive thing for the stock market. And the Fed has cut rates 12 times when the S&P was within 1% of its all-time high, and the market was higher 1 year later, all 12 times with a median return of 15%. So once again, the historical odds are quite positive at this point for this bull market to last. But of course, we can see corrections along the way. So this doesn't mean that it's going to be a straight line up from here. We could easily see a 5 to 10% correction. That's always a possibility in the market. And this is another overview showing what usually happens when rates are cut. And there are, of course, some notable exceptions, but in general, it has been positive for stocks when rates are cut. So the most likely scenario at this point looks like inflation would remain low, but it's certainly a risk that it can rise again. So it's something to keep an eye on. It looks like the Fed is going to cut interest rates further. And also the odds at this point are that we will avoid a recession within the next 12 months, which should be bullish for markets. But we will still see volatility, especially until the US election, probably even after, if there's no clear decision immediately. So we could expect volatility and also corrections in the short term, but we cannot know for sure, of course. So the scenario for me is cautiously bullish, but I would say that a lot of things in the world can change this scenario. So uncertainty surrounding the US election could lead to a correction. Geopolitical unrest, for instance, like if the situation in the Middle East escalates even more than where it is currently, and it's a quite escalated situation that can, of course, affect the stock markets. We could see rising inflation again. This could lead to smaller rate cuts, and then another risk is, of course, that we would have rising unemployment again and risk of recession, but that's a lower probability at this point. I think the three first points are the main points to look at least on the short term. That's the most likely risks to keep an eye on. And all of those three or all of those 4 points could disturb the rather bullish outlook that we have right now. So as I've said before, anything can happen in the stock market. So that's always important to make sure that you have an open mind to that anything can happen. And yeah, that's just very important. And then that concludes the first part of this recording, this presentation. I just want to say that I would urge you to make investing a habit like I've done. Take a little bit out of your paycheck every month and invest it. You're going to be happy about having done this later. Maybe do it automatically if it's possible. At least make sure that you do it continuously, like every month and every quarter, or even every 6 months. The main thing is to do it continuously, because in this way you will actually avoid having timing risk in the market, which is one of the risks that are yeah, very common. That's actually the main risk of the market, that you may risk to when you invest in the stock market, you can risk losing your money if you time it wrongly. And there's no way to really time it in a good way, especially not as a private investor. You just have to invest continuously, in my opinion. That's the best strategy. And then I've had quite a few questions on eToro, so I'm going to go through those questions now. So first question is that this user is writing that he's getting a bad feeling about crypto, and especially ADA, which is Cardano, one of the larger cryptocurrencies. We are so far beyond halving, the Bitcoin halving. He's referring to, and nothing happens, and if there could be more to the downside. We had so many positive news, but no movement. So how do you see the crypto market in general, and especially ADA? And right now I actually see Bitcoin as having a possible breakout. So it could be a bullish scenario for crypto, especially Bitcoin at this point, because we're seeing some movement in the markets, and Bitcoin is very much driven by the sentiment, and right now the sentiment is actually quite positive. So I've actually added a bit to my Bitcoin position, which means that I have around 2% in Bitcoin right now of my portfolio, and I see it as a possibility that we could have a bullish run for the next month or into 2025. And we'll have to see how it goes. It's very sentiment driven, so there can of course be negative news to change this. But if Bitcoin rallies, then it may drive some of the other cryptocurrencies as well. And some of those currencies may even rise more than Bitcoin. So there's some movement in the cryptocurrency market. For me, it's just like I want to stay invested only in Bitcoin. I think that any of the other coins at this point are kind of risky, very risky investments, and Bitcoin is slightly risky too. So in this sense, I wouldn't invest in other coins at this point, because I think the crypto market has the general problem that you don't see a much of mainstream adoption like you've seen with AI. Like everyone is using ChatGPT, and 200 million people, but so far we haven't seen that kind of adoption in the crypto market. And for this reason, I think we need those very popular cases. We need more public adoption for these coins to seriously gain in value. But of course, we can have short-term hype, and this can drive value for Bitcoin and also for the other currencies. Because every time Bitcoin rises a lot, then you will usually see other coins rise on the back of this, and that's certainly something to look out for. But regards to Cardano and ADA, I would certainly look at how much is this chain being used, how many developers are using it. Is it the best place to be invested, or is there more adoption on some of the other chains? And that would be something that I would be analyzing if I was investing in ADA, which I'm not. So that's my answer to this question. I hope it's sufficient. Otherwise, you will just have to ask again on my wall. So this screen dump is actually a few days old, and it just shows you the sentiment right now. Bitcoin is actually around 67,000, so it's knocking on the top of this channel. And if we see a breakout now, which is not unlikely, we could see Bitcoin rally and make a new all-time high, maybe up to 78,000 US dollars. It's not impossible. And I think one of the reasons for this is that there may be some hype about that if Trump wins the election, it seems like he's suddenly very much pro crypto, and that could have a positive, in fact, very positive impact on Bitcoin. So if we say that the US election is right now a coin toss between Harris and Trump, then if Trump wins, then there's a 50% chance of Bitcoin rallying on the back of this. But if he doesn't win, then we will have to see what happens. But there's certainly some movement going on right now, so I think it's going to be interesting to follow it, and I follow it like day by day and even hour by hour right now. And this is a chart of Cardano. It's not very positive for me to enter something like this. I personally wouldn't, but I would like to see it make a positive turn and actually start rising. And if we see it rising, then there will be a lot of momentum buying and people will jump on the bandwagon. So that may be the point to buy it if you really want to buy it, but I wouldn't do it myself. So what are your thoughts on the stimulus given by China? Is it time to expand in that market? And I think that China is certainly very interesting at this point. It seems like the Chinese government is very serious about the stimulus that they are giving to the economy. So I think it's certainly something to look out for and maybe have a little bit more exposure to China. I'm looking a bit at it myself. So I don't want to have too much exposure to China because I think the Chinese stock market is very volatile and quite uncertain. So I try to keep the exposure pretty low, but I think I have two Chinese stocks at this point, but it's certainly possible to expand it a little bit. So that's something that I would be looking a little bit at and maybe doing a slight expansion in the market. But all the time I need to follow, and I think you need to follow if you want to invest in China, what's going on with the government, and all the time they can, change their mind. But it seems like right now they're quite serious about giving stimulus. So at this point, I think it's interesting to start taking a look at if there are some possibilities in the Chinese market. So then the next question is about green stocks. What would I need to see in order to invest more in that area? So green stocks have been a little bit mixed this year. Some stocks are doing well. Mostly they're not doing so well. And I've been looking at this ETF over a period of the last year, and it's not really moving anywhere. It's a clean energy ETF showing that right now there's not really a positive momentum in the stocks, and we're actually seeing like this kind of a wedge pattern showing that the sentiment is very mixed with regards to those stocks. And for me to invest in this, I could go with some single stocks that are performing well that I like, and I am considering to do that. I'm not going to say which ones, but to really invest in this market, I think we would need to see a positive momentum, maybe a break of this wedge and a positive momentum in that market for me to seriously invest in that because right now the momentum is not very positive, and the market has been performing badly, partly due to the higher interest rates. And when this is changing, and it may be changing now, then it's certainly possible to take another look at this market to see if it would be the right moment to jump in. So I think it's certainly something to look out for. For me, this is not the moment, but I'm taking a look at it continuously. And I think for the future, like for the long term, it's certainly something that you would like to be invested in. Clean energy, obviously. It's going to be a good investment over time, in my opinion. But right now, maybe not. If the US market is falling due to a global issue, for instance, war abroad, supply concerns and so on, why does all stock seem to fall at the same time, even if it's not related to the issue? And that's a very good question. And most of the stock market trades on correlation. So this means that when you have a red day in the stock market, then quite often you will see 90% of stocks being red. And as you say, maybe not all of these stocks are related to the issue. Like, for instance, a war in the Middle East will have a huge impact on some stocks. Like, and not even like a war like we have now, but an escalation. Um, but maybe not all companies are affected by that as much as others. And I think that's actually an opportunity to try to pick those stocks that are being part of the correction. So let's say that something geopolitical is happening and you see some stocks falling 10%, but without much relation to this specific issue. That may actually be a buying opportunity. And I think the smart investors look at it this way. So I think that sometimes the stock market is a bit overcorrelated in this way that it shouldn't really be like that, that all stocks go down at the same time. So it's a very interesting opportunity if you can pick the right moments to buy good stocks. So then there's a question about inflation. If it goes down more, would I start being underweight the stocks with low inflation risk? And would I reduce my hedging positions? And when would I do this? So first of all, I don't have many pure inflation hedges in my portfolio anymore. I'm not invested in, the commodity ETF that I was invested in 2022. And also a few of the other hedges are not there anymore. So at this point, I don't have too many hedges, so I wouldn't really change much if we saw inflation staying very low. I may be investing in some other things, but I don't see me closing any like specific hedges. I think the main risk at this point is probably that inflation could rise again. So that's what I'm more on the look for. And actually, if this happens, I would be adding hedging positions again to the portfolio. So this is the place where I am right now. And actually, these were all of the questions that I had on my wall on eToro. You're always welcome to contact me on eToro. And yeah, sorry, I've been ill for a few days, but I'm almost over it now. You're always welcome to write to me on eToro, and I usually reply back within 1 or 2 days. And yeah, I just hope that you have a good impression of what I do and how I invest. And you can always contact me on eToro or any of the other platforms that I appear on. Thank you very much.